Gold and silver are pulling back, and two familiar forces are behind the move: a stronger US dollar and rising Treasury yields. Here is what is driving the pressure and what to watch next. When Treasury yields rise, holding gold or silver becomes less attractive. Those metals pay no interest and no dividend. So when bonds start offering better returns, some investors shift money out of metals and into fixed income. That rotation puts downward pressure on prices. A stronger dollar adds to the problem. Gold and silver are priced in dollars on global markets. When the dollar rises, buyers in other countries have to pay more in their home currency to purchase the same amount of metal. That tends to reduce demand from international buyers, which weighs further on prices. Mining stocks are feeling the pain even more sharply than the metals themselves. That is fairly typical. Shares of gold and silver producers tend to move with leverage relative to spot prices. When metal prices dip, but operating costs, fuel, labor, equipment stay high, profit margins get squeezed fast. Equity markets price in that risk quickly, which is why mining stocks often fall harder than the metals in a sell-off like this one. The broader context matters here. This kind of macro-driven pullback is not unusual. The pattern of metals softening when the dollar firms up and real yields move higher has repeated itself across multiple market cycles. The Federal Reserve remains the central variable. Markets are watching closely for any signal that interest rates will stay higher for longer. That scenario supports both the dollar and yields at the same time, which creates a double headwind for precious metals. Any Fed commentary or economic data that points toward tighter policy for longer will likely extend the pressure. On the other side of the trade, it is important to separate short-term financial market moves from longer-term demand fundamentals. Central banks have been steady buyers of gold. Industrial demand for silver remains a real factor, and appetite for physical metal among retail and institutional buyers does not vanish just because yields tick up. The current episode looks more like a rates and dollar story than a broad collapse in metals demand. The two numbers worth tracking right now are the dollar index and the yield on the 10-year Treasury note. Those two gauges are setting the near-term direction for gold and silver. If upcoming US economic data comes in softer than expected, or if Federal Reserve officials signal any shift toward a more flexible policy stance, the pressure on metals and mining stocks could ease quickly. Keep those data releases and Fed communications on your radar, because right now they are the most direct input into where prices go from here. Bullion Flash is brought to you by Absolute Bullion, a California-based dealer in gold, silver, platinum, and palladium. More at absolutebullion.com.